This is Tonight. I'm Bruce Whitfield. With more and more smart investors moving toward exchange-traded funds and away from pricier managed funds, we decided to get John Davies, the Vice President of Global Exchange-Traded Products at S&P Dow Jones Indices, and Deborah Fuhr, who's a partner and co-founder of ETFGI, to talk about the latest trends in the industry and how recent sell-offs in global markets, particularly, imagine if you had a Shanghai index in the last couple of weeks, you'd have lost 20% of your money. Exchange-traded funds can be scary when markets go against you. I mean, Deborah, we look at Shanghai, for example, the Shanghai Composite, from the beginning or middle of June to the end of June, 20% plus, boom, gone. And that's what scares people about exchange-traded funds sometimes.
Well, it can, but I think the reality is ETFs are doing what the market's doing, and so that at least gives you some level of certainty as to the performance. The real challenge is when many investors are putting money into active funds, we find that a very large proportion are not beating the benchmarks. So you can actually do worse than the benchmark by giving money to active managers, because many consistently don't do better than the benchmark. So you find that in the US, 86% of active managers last year didn't beat the benchmark.
86 in the United States. Okay.
83 in Europe.
And South Africa's already got a very similar proportion as well. I mean, John, we look at it, and John Bogle, who's the father of this sort of index investing and looking at ETFs, has done incredible research into it. And Americans seem to have bought into the ETF concept very strongly. The Europeans, are they that big into exchange-traded funds?
They're beginning to embrace ETFs for what they actually are. They're a transparent, low-cost access vehicle. They're not the new panacea of an investment strategy. They are a tool that gives the man and the woman on the street the similar access to investment strategies that larger institutions have enjoyed for years and years. So I think that, to your point, yes, Europe has lagged behind the US, but you know, ETFs have been in North America for 25 years. They've only been in Europe for 15. There are more products in Europe, but there's a third of the assets. But the growth is increasing.
But what is it about us that we would trust a human being who underperforms more than the market? I mean, there's a psychology to it. There's an investment psychology.
Yeah, I think that, you know, I've been in the sort of UK markets for nearly 30 years now, and I think, you know, I've lived through the star manager culture, but that's slowly going away, because as investors get more educated about their investments, they're, to Debbie's point, they begin to understand the costs involved in actually holding these mutual funds, the active funds, that, you know, on average across the globe, 3 out of 5 managers just can't beat the benchmark due to costs.
That's the point. But it also comes down to a point of complexity. Now, in the South African environment, and I don't expect you to know the South African environment, as I don't know the US and the UK and Europe nearly adequately, but we've got more than 900 unit trusts in a market with 150 really actively traded companies, 300 ones investable companies, and a bunch of others as well, 450 companies in total. That's complicated, but already we've got about 100 ETFs in South Africa. At some point, you've sort of got to start paying somebody to give you advice. Doesn't that undermine the great benefit, Deborah, of the ETF?
Well, that's a great point, because that's part of the reason that ETFs have slowly been growing in Europe, is that financial advisors in Europe and South Africa are starting to advise as opposed to being paid to sell products. So that's been the challenge for adoption in Europe, is that many financial advisors are still paid to sell their products. And when you're paid to sell one thing and not paid to sell ETFs, you don't talk about ETFs. And so that difference in performance, where you're paying more for something that isn't beating the benchmark, is bad for your long-term performance.
And I suppose it's a natural evolution, isn't it, John? I mean, we've seen, particularly in the United Kingdom, and I'm not sure about the US example, you're based in London, Deborah, but as the advice model has changed from commission-based to fee-based, with treat customers fairly emerging in the UK, we are getting that sort of regulation coming into South Africa now, where advisors are expected to charge for advice rather than take a commission from the highest bidder. Suddenly, if advice can be objective, then it's quite a hard thing to not sell.
Well, once you wake up to the fact that you have to give the best advice to your client, and that you have to help them build the most cost-effective and efficient portfolios, then there is only one answer. It's ETFs.
What will make the market in the future, though? If the world goes completely towards exchange-traded fund, what happens to volatility? What happens? You've got to have market makers. You've got to have active investors, don't you? You've got to have people who believe they can beat the market. You'll have private investors. They're not nearly as strong enough force, but you do need the asset managers. I mean, there's an ETF industry, surely, Deborah. You need asset managers who want to have the ego trip of beating the benchmark.
Well, Well, and some managers do beat the benchmark. So I think the challenge is finding the ones that do and do it consistently. So I think we're always going to have active managers that are trying to deliver that alpha story. And today, ETFs...
Provided, of course, they outperform by more than the fees they charge.
Well, that's true, yes. And that has been the challenge, because if most active managers didn't charge the level of fees they charge, they would be, in many cases, beating the benchmark.
Yeah.
So fees is an issue. But I think what you have to remember is today, ETFs globally are less than 10% of all assets in mutual funds. So we're still small, but an interesting statistic is at the end of Q1 this year, our data found that the ETF industry globally, which as John said has existed for 25 years, is only $13 billion smaller than the global hedge fund industry that has existed for 66 years. And part of the reason for that is if you looked at the average performance of hedge funds in each of the last 6 years, it has underperformed the S&P 500. Yeah. So you're paying 2 and 20 for something that is not delivering S&P 500 performance. You can buy an ETF for 5 basis points and get S&P.
No, but that is the point. I mean, but you can't just sell this on price, John. I mean, price is terribly compelling.
I think that if you look at, there's over 5,700 ETPs across the global markets exchange-traded products, whether they be funds, notes, certificates. But what that sort of breadth of product gives investors is options across all markets. There is no one segment of the market that you can't access now through ETFs. So yes, price is an important factor. The transparency of the ETF structure is equally as important, because from day to day, hour to hour, you can see what you are really exposed to. And if you change your mind on a particular market, at the press of a button or a phone call, you can change your allocation.
I mean, but ETFs also allow for a certain amount of adventurousness, and I suppose it comes down to a marketing job. I was looking at some stats the other day of the outperformance of women chief executives in the United States. Some research was done about outperformance by women-run companies over a 12-year period, and the outperformance by those companies was by 200%. You could have a women-only ETF.
There is an exchange-traded note on that. Yes.
Is there? And how does it do?
I haven't looked at the performance. With over 5,700, it's hard to know the performance of all of them. But yeah, I think you're right that there are many different products, and that's why I think it is important to pay for advice. So many advisors today
Most advisors are male, middle-aged and balding. They're not likely to give you a great tip like that one, though.
Well, but what you do find is a lot of them are going to risk profiling their clients. So what is your tolerance towards risk? Are you saving for retirement, putting your children through university, buying a house? And so based on that, they then put you into different solutions. So low risk, moderate, dynamic. And so we're seeing a growth in that, and also a growth in robo-advisors. So for people who felt before they didn't pay for advice, you can go to an online robo-advisor where you plug in some characteristics about you and your investment style, and out pops a portfolio, which also is using ETFs.
But that's also really interesting because nobody knows themselves that well. I mean, you try and do a profiling yourself, it's quite scary because you have a very different perception as to what your persona is to what you really are. That's quite scary when you start entrusting yourself to yourself.
Well, but you're answering factual questions. So how much money do you earn? What are you saving towards? What is the time horizon?
How do you feel about
risk?
Yeah.
Exactly. So it's asking you factual questions, not something where you're defining yourself in a way that might be
You just had a big event downstairs where you've been launching various ideas and various products into the South African market. What are you bringing to us, John?
Well, I think that the sort of buzzword across all markets at the moment is smart beta. And it's a term that a lot of
beta
people...
is outperformance?
No,
beta is the market.
Market, beg your pardon. Alpha is outperformance,
Alpha is outperformance.
So smart beta
sits in that sweet spot in between. What smart beta sort of covers is factor-based investing, dividend investing, anything that moves away from the market cap type of product, and it sits in between.
But who are you aiming this? I mean, this is professional investors. This is specialized stuff. A lot of people can understand buying a BHP Billiton share or an Anglo-American share, or in the South African context, the Satrix Top 40, which is the index of the top 40 shares. Suddenly you get into jargon and technicalities. Who are you aiming this at?
Well, I think that these tools fit in all portfolios, because they look at different cycles of the market and what different outcomes that the investor wants. So to Debbie's point about, are you looking to buy a house? Are you looking to fund your school children fees? you can look at certain factors, whether it's dividends, whether it's managing risk volatility, looking at quality of companies. You can have different products that aim specifically at that strategy. And another aspect of it is that it's not smart beta as in it's better than the market. What you're trying to achieve is taking a systematic approach to an active strategy.
Does it make it more scientific, taking emotion out of it?
It's taking the emotion out of actively trying to manage the market, but also putting it into a systematic framework that is disciplined. And if you stick to the framework, you will get the outcome that is designed to give you.
I mean, anybody who invests and who has invested successfully over a long period knows that no matter how emotional you are, provided you're disciplined, Deborah, your track record will show for itself. This simply systemizes, big word, yes, at this time of night, systemizes it and sort of keeps individuals, human beings, disciplined in the process.
Yeah, and I think if we go back to smart beta, so a yield strategy which generates income does resonate with many investors, especially retail investors that like income. So I think some of the smarter beta strategies based on different factors, so if we're talking about value, if we're talking about min-vol, min-var, may be more professional, but I think many investors understand the benefit of income, and so high dividend strategies, which are factor-based smart beta, have been popular for over 14 years.
We've all seen The Wolf of Wall Street. We all want that adrenaline rush. We don't necessarily want to do all of the stuff that The Wolf of Wall Street got up. Some of it was quite fun. Where's the adrenaline in the science of this kind of investing, John?
I'd say that there is no adrenaline.
Is that the point?
Yeah, it's being sensible and logical about managing your investments. And you know, somebody said earlier today that it's easy to create wealth. Spend less than what you earn, take the difference, and put it in a passive product that's safe.
For a long period of time.
For a long period of time. So it's about taking the emotion out of this and investing your money in the most cost-effective way. And that's what ETFs give you.
Thank you very much for both coming in. It's nice to see you both. John Davies, Vice President of Global Exchange Traded Products at S&P Dow Jones Indices, taking the adrenaline out of investing, and Deborah Fuhr, who's a partner and co-founder at ETFGI. She's also based in the United Kingdom. There'll be more tonight, tomorrow. Till then, thank you for watching. Good night and goodbye.